day, everyone. Thank you for joining us once again here at Seaford and Brew for our economic briefing. For today, we're going to review over the fourth quarter GDP release and then talk about the Fed statement and look at the projections for where Fed funds could go throughout the remainder of the year. So let's start off with this GDP release at that 6.9%, very strong. In fact, it topped the estimates. And we'll look at why we saw such a strong GDP. But so strong, we'd have to go all the way back to the second quarter of 2000 in order to get a quarterly GDP number that exceeded this quarter. So substantial, over a 20-year period, we've exceeded that. So let's look at then also the different components of the GDP. And the one area that really sticks out here is this investment. This investment contributing 515 basis points to the overall growth rate of GDP. Substantial. We'll look at the consumer contributing that 225 basis points to that overall growth. And then we had some pull-offs with inside the government, subtracting 51 basis points, and exports, imports, the net of that actually came out to zero. They balanced each other out this quarter. So let's take a little deeper dive into some of these numbers. Looking at the consumer portion, we can see, as we saw before, contributing that 225 basis points. Recreational goods and services, or goods and vehicles, actually contributed 28 basis points to that overall total. Very substantial. And then we drop down into the services arena, and services, we had 79 basis points contributing from healthcare alone. We have transportation services at 38 basis points and recreational services at that 43. So we had substantial increases in recreation alone, and then healthcare contributed a fair share of that overall 225 basis points. Some of the items that were detractors, we had motor vehicles and parts taking off about 20 basis points. We know the supply chain issue there is causing havoc on those sales and the availability of these vehicles and even parts. So that's pulling that off, and that was a substantial detractor from the overall level of GDP growth, contributing from the consumers. When we look at the investment, that private investment portion, 515 basis points we saw providing to that overall growth rate. And we look at some of the individual factors. We had information and processing systems at 45 basis points. Then we had intellectual properties contributing a 53 basis points, very substantial. And then we drop down to the biggest number on this chart is that inventories, and that inventories giving us 490 basis points added into GDP growth. That was substantial, and that's the big surprise in here is this large uptick in that inventories number. Now, we're talking to a number of different banks, and we've seen at some institutions their loan customers, their commercial loan customers, beginning to build up that inventory, not just to sell it, but just to make sure they have it on hand. That in conjunction with, we saw the retail sales pull off a little bit in December, and perhaps we're seeing some buildup in inventories because they built up inventories in October and November with the anticipation of the sales in December, which didn't come to fruition. So we had those additional inventories. Now, when we're looking at the first quarter, the fact that that inventory number is so large might give us pause and say maybe the first quarter of 2022 is going to be subdued a little bit because we're not going to have that huge ramp up in inventories. But hopefully we'll see it on the other side, looking at that consumer segment. Overall, when we look at the entire year for 2021, we can see the growth tops the past 36 years at 5.67% for the year. We'd have to go all the way back to 1984 before we get an annualized number that beats that estimate. And 1984 was 7.24, and then we'd have to go back to the prior number of 1966, where it was 6.59. So tremendous growth overall when we were looking at our GDP for 2021. Looking at Fed funds and coming off of the Fed release on Wednesday, we know the Fed is just about at the point where they're going to start increasing that Fed funds rate, giving us a little tighter monetary policy. If we look at the CME Group's expectation here, or the implied probabilities for rate hikes throughout 2022, we're up to 5 rate hikes at this point. 5 25 basis point rate hikes starting in March, and then happening in March and May and June, potentially taking a break in July, and then in September again, another rate hike, and then another rate hike in December. Now, for this to, in my mind, for this to come to play, we'd have to continually have strong economic numbers. GDP would continue to have to run at that 5% level every quarter, and we'd have to continually to see inflation ticking up or remaining high. If we were to start to see the pull off in the GDP, where that growth rate gets back down to that 2-3% level, we start to see somewhat of a pull off in the overall growth in inflation. We could see this kind of projection get derailed a little bit and maybe come in at 3 or 4 increases within 2022. So while we have these as our implied probabilities right now from the CME Group, we do know this is data dependent, and it's all going to get back to what's the economy doing. That, coupled with the fact that the Fed has said that they will think about that process of reducing down their balance sheet. So we know that in March they're going to be done with adding to their balance sheet. The next part of that is then reducing down their balance sheet. And the Fed said that they're going to allow to let the increases in the rates take their part before they start to think about and release when they're going to begin that reduction of their balance sheet. However, if we recall, the last time they did that, remember, they had a liquidity crisis in September of 2019 that caused them to have to push money back into the market. So there's a lot of interplay here that we have to digest and really analyze to see what impact that's going to have. But we know the impact overall on the yield curve. Now we're seeing that push up from where we were back at the end of the year. We had the 10-year Treasury ending on Thursday, the 27th, at a 181. There has been some volatility in this number, of course, as the different economic numbers come out, and with the whole issue in the Ukraine and the overall equity market pulling off, we could see some flight to quality, could continue to put downward pressure on these overall Treasury rates, particularly that longer end of the curve pushing that down. So our expectation right now is that the 10-year Treasury most likely not getting above that 2% throughout 2022. but that's just an estimate. It can potentially get above that and then come back down. However, if we do start to see some negative economic numbers, slowness in the overall growth rate in GDP, maybe a little bit of a reduction in that inventory numbers, and inflation in general starts to come down, we could see some suppression on this long-term rates. That being said, we could also see some flight to quality if we were to see an issue arise between Russia and Europe because of the Ukraine situation. So there's a lot to digest when we're looking at this, but right now what we're thinking is that the rates are going to be fairly volatile within a 20 to 25 basis range, but not get up above on a consistent basis that 2% on that 10-year Treasury. So we'll have to see how that plays out as we go through this first quarter. Well, that's what we have for you today. We'll talk a little bit more about rates in our next briefing when we look at the performance of the Community Bank Benchmark Group for the fourth quarter. So we look forward to seeing you again. Have a great day.